Wednesday, September 29th, 2021, Monaco 64, home of alternative economics and contrarian views. I'm looking at the bond market, the government bond market, and it's getting very interesting. We're seeing yields start to rise, not very sharply, but nevertheless, breaking key levels. Like here in the UK, the 10-year gilt yield yesterday went through 1%, went up to about 1.05. It has come back down. We're seeing treasury yields also go up in the last week or so from around 130 to almost 160. Yes, we have the biggest bond bubble ever. So what does that mean? Well, that means that our governments, our corporations, our consumers are the most indebted ever because a bond bubble signifies that investors have bought that debt, that debt is the most overvalued ever and will never be able to be paid back. I think the total debt of the world is something like over $300 trillion, probably more now, approaching 400 trillion. And the GDP of the world economy put together, all the countries put together, is around 80 trillion. So you do the maths, it's an impossibility. And I think there's a lot of complacency about inflation, and it will turn into hyperinflation. And why am I so convinced of that? Well, I think it's because very few people, except for you and me and a few others out there, really know what inflation is. And they think that demand destruction, they think that it's transitory. Demand destruction basically is the idea that the higher prices will make people consume less, and that will lead to lower prices again. That's a fallacy, in my opinion. They expected that. The Keynesians expected that back in the 70s, and it never happened. And they expect as well commodity prices to come down. They expect that everything is transitory. This transitory idea, I think it's becoming like discredited by the day. And yes, there's the old saying from Lenin that inflation is the way to destroy the bourgeoisie, a constant process to debauch the currency without 1 in a million person knowing that it's happening. And I would actually argue that it's still 1 in a million people that actually know what inflation is. And I was reading this article from Bloomberg. I've subscribed to Bloomberg now because we need to know what's going on out there. I've got the FT subscription as well, but it's worth it. And the article was from yesterday. It says, commodity price surge deals stagflationary blow to world economy. I saw that headline and I thought, oh, they're finally waking up to it. But let's go through the article. And then I'm going to refer a great book, which I've referred you to already. Some of you probably haven't heard of it because you're new subscribers. After I finish this, about a banker in Europe in the 1900s that knew everything about inflation. So the Bloomberg article says the world economy is facing a buildup in stagflationary forces as surging energy prices boost inflation and slow the recovery from the pandemic recession. So right there is the mistake. They don't know what inflation is. They're saying that energy prices are causing inflation. No, inflation is leading to a lower value of the currency and higher prices. If you've followed me, you should know that by now. So right off the bat there, that's the complacency. You see, they're looking at the wrong thing. They're making the wrong conclusions. Oil's climbed to more than $80 a barrel. That's the Brent crude type for the first time in 3 years. Natural gas for October delivery traded at the costliest level in 7 years. And the Bloomberg Commodity Spot Index rose to the highest level in a decade. Yeah, and it's always rising, rising, rising to talk about rising prices, but you could very well talk about a falling currency. And I've been warning people about the inflation, that it would lead to rising prices for years. And there's still some people out there who think we've got deflation. So maybe one day they will wake up. Food prices are also advancing, driven in part by crop failures in Brazil, with a benchmark UN index up 33% over the past 12 months. So there again, they're blaming a crop failure in Brazil for higher prices, not the fact that government and central banks have inflated the system out of all proportion since 2008. It's only starting to show up in consumer goods, in services, in shortages now. Up until a couple of years ago or 3 years ago, it was only just showing in asset prices of the NASDAQ and the bond market, real estate. Now we're getting the bad kind of price rises where real things go up. And they tell us that those real things are causing the inflation. It's weird that they don't tell us that the real estate prices and stock prices and bond prices are causing inflation, right? It's quite amazing how they have one explanation for one part of the inflation and another for the other. Rising costs for households and companies are hitting confidence while pushing inflation faster. It's not pushing inflation faster. So I'm going to stop here, so you get the idea. The mainstream still has this idea that commodity prices are causing the inflation. Droughts in Brazil or whatever in Brazil, frost to the coffee crop that we had recently. So here at the end it says, many officials also still insist the current spike in prices will fade without the need for action. European Central Bank President Christine Lagarde said Tuesday that the key challenge for policymakers is that we do not overreact to transitory supply shocks that have no bearing on the medium term. I think she also said that if you strip out all commodity prices, there's no inflation. I mean, that was a bit of a joke. So I want to go now to the Raven of Zurich. It's the memoirs of Felix Somary, and I'm going to come to who Felix Somary was in a second. And this book, you can find a free PDF of it. I'm going to put a link below in the description of this video. I highly recommend the book. I read it many years ago, and it's one of the reasons why I have the views that I have about things, about money, about inflation. And on page 98, this is what he says. The state alone is responsible for inflation. Inflation without government, or indeed against government, is impossible. So you might say, what is he talking about? Well, he knows, of course, what inflation is. Inflation is the exorbitant exorbitant increase in the amount of money and credit out of thin air in a fiat currency system. And here he was talking about the inflation that we had during World War I from 1914 to 1918. And that inflation continued after the war. And I would say the inflation we've had since 2008, and you might say, what inflation? Well, the inflation of the money supply and the credit, all the QE, all the loans that people have taken, mortgages, all the corporate debt, that's the inflation. Yes, it hasn't resulted so far in a bad rise in consumer prices, even though it's starting to now. But back in World War I as well. It was only after the war that the inflation started seeping through into real goods. And eventually, of course, from 1922 to 1923, we saw a total collapse of the currency of Germany and all the other central powers in Central Europe, like Austria and Hungary. And I'm afraid we are on the same road, and there's a lot of complacency. And I was looking at his Wikipedia here, Felix Somary, so you can know who he is. Have a look at Felix Somary, a very influential character. And this is what he said here. After the war, that's World War I, European banks were long on war bonds. Well, you could replace the war for after, I don't know, COVID, right? Some people are equating it to a war. European and all world banks are long loads of bonds, not just war bonds, worth absolutely nothing. That's right. The only reason they have any value right now is that the central banks are issuing reserves out of thin air to buy them. So can you understand why when they talk about tapering and raising rates, it's going to be hard, because if they stop buying these bonds, investors are not going to keep buying it, because the only reason they're buying it is because the central banks are there to put a put underneath them, because I'm sure investors are not stupid to know that these bonds, these loans will never be paid back. But anyway, this is what it says. He realized that the choice was between bankruptcy and hyperinflation. But although he favored the former, it was the latter which ensued. He predicted the Great Depression, which began in 1929, as early as September 1926, when he gave a lecture warning of the dangers of relying on the U.S. for credit, given the protectionist tendencies of that country. It was because of this prediction that he became known as the Raven of Zurich, the raven being a bird associated with dire omens. He was one of the several economists who later expressed the view that the Depression might not have occurred if there had not been a conjunction of events, including the election of Hitler in Germany and of Roosevelt in the US. He was in New York City when the stock markets were plummeting, and seeing that fellow bankers were buying recklessly, he sent a wire to Zurich telling his associates there. From 1941 to 1943, he advised American Department of Defense on finance issues. He had been consulted regarding the methods that should be deployed in order to establish a sound currency in the European and African war zones. This being seen prior to the Allied landings in North Africa and France as an important prerequisite for achieving economic stability. When they told him that the Americans were thinking of abolishing the Japanese emperor, he was outraged. And then he asked, "With whom are you going to sign a peace treaty?" So either way, as Felix Somary said, these worthless bonds, there will either be bankruptcy, and in that case, the whole system will implode, or there will be hyperinflation. And I think they're gearing us up to the hyperinflation. And in that case, the bonds will be worthless as well, because the currency will be worthless. And that's why you need to be out of the system as much as possible, in my opinion. You need to do your own research, your own reading, not only of economics, but of history and money, to decide whether you think that's the right thing. I've been doing it for 20 years, and that's the way I see it. Even if the central bankers start tapering a little bit, even if they raise rates by 0.25%, it's going to be insignificant. In terms of all the inflation they've created in the last 13 years or so, if they really want to stop the inflation, and by inflation, I mean the easy money, easy credit, the creation of money and credit, not the rising prices. They will have to let interest rates go to double digits at least, and maybe even over 20%. Can you imagine what would happen to the world economy, which is based on credit completely, where companies don't own anything anymore, where they outsource everything, where they lease everything? It would be the end. So unfortunately, I see hyperinflation, and not many people will see it, but hopefully you will be prepared for it. We're starting to see the signs of it already. What about interest rates? Well, I think they will start rising. Yields will start rising, and it's going to be tricky. I think what the central bankers will do is that they will start doing even more. They will increase the QE to keep those yields low. They've got no choice but to keep inflating, and they're going to be blaming everything else but themselves, right? But Felix Somary is probably smiling in his grave, saying, look at those fools. So anyway, let's quickly look at where the markets are this morning. It's 8:45 a.m. London time. We've got spot gold at 1739. It's up $5. Range has been 1733 to 1743. Silver is down this morning. It's down 17 cents at 22.26. The stock markets are rebounding this morning. We've got the Dow future up about 200 points. The NASDAQ is up about 150 points, and the S&P future is up about 32. The FTSE is up about 2/3 of a point. We saw sterling get hit hard yesterday. It fell over 1%, I think. Yeah, it fell quite hard. This morning, it's testing already 135. Right now, it's unchanged at 135.30. The euro is down about 1/8% at 116.64. The dollar is down 0.2 versus the yen at 111.30. Dollar's up slightly versus the yuan at 646.77. Aussie dollar is up 0.2 at 72.52. The dollar is unchanged versus the Canadian dollar, 126.88. And the New Zealand dollar is down about 0.2 at 69.47. Yeah, yesterday we saw crude and natural gas move up quite sharply, making multi-year highs. They have corrected a little bit. Crude oil this morning, WTI, is down just over $1 or 1.5% at 74.08. Brent crude got up to around 80. It's now at 77.25. Do I think the bull market in commodities or bear market in currencies is over? No way. It's just beginning, unfortunately. Natural gas got up to like 630. Right now it's at 578, so it's down substantially from the highs yesterday, but way above the key $5 level that we broke through recently. I expect a lot of volatility in natural gas. Yes, you're going to see a lot of headlines and stories about Boris Johnson, the UK government, saying that they're going to fix things, that everything's okay, not to worry. And I wouldn't believe any of it. They've got no control over it. This is not just Boris Johnson's fault. It's been brewing. This thing has been brewing since 2008 when Gordon Brown, or even before that, when Tony Blair was in charge, when Gordon Brown was chancellor. Yeah, he became prime minister. The credit boom has been happening since then, and this is just the bad part of it. This is the payback time. This is what it is. You can't expect the world to live on borrowed money forever. Eventually, we're going to have to pay the price for it. And that's how we pay for it. Through the collapse of the currency, through higher prices. Yes, it's going to be very hard to unwind this, or it will be impossible, in my opinion. So just to finish off, let's look at the bond markets. We're going to look at the 10-year yield, and in the US, and also the gilt yield, which is the treasury equivalent for the UK. Yeah, the 10-year yield has come off a little bit here. It's at 151, down 2.5 basis points. I think yesterday we got up to almost 160. So the bond markets there's probably been a bit of intervention from the central bankers and the treasuries. Don't forget, the US has the Exchange Stabilization Fund, which copied actually a stabilization account that the Bank of England and the UK Treasury also have. So don't be mistaken that they are not going to try to keep this Ponzi going by manipulating bond prices. The 10-year gilt yield is right now down just over 1 basis point, about 0.99. Yesterday we got to 1.06, and I think they're trying to keep it below 1. I think they will not succeed. I think it's a bad sign that the currency, the pound, is dropping and yields are going higher. That's not a good cocktail of stability for the economy or for anything else for that matter. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.